Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to hit up Twitter, see what they're talking about, go over some commodities, financial markets information, and obviously I'm going to interject my financial opinions. But let's just dive right into it. Let's see what's going on in the markets and at least what I'm sharing. So it's at Finding_Finance if you want to follow me. And if you want to follow and join our community, it's finding-value.com, and you can use the word discount, the coupon code. So we've got Game of Trades here. He says, stocks are pricing in a Goldilocks macro environment. Everything is pointing to the exact opposite. Everything, he says. Everything. All right? Well, I've got a counterpoint right underneath it. Here's the counterpoint to everything is pointing to the exact opposite. Global oil demand reached the highest level ever recorded by Jody data in March, driven by growth in China and China's total product demand increased by 1.6 million barrels per day on a month-over-month to 17 million barrels per day, while U.S. demand rose 1.77 million barrels per day to 21.77. Well, if everything was pointing the exact opposite direction, you would not see increasing oil demand. I'm sorry, Game of Trades, but what you are saying is not factually correct. Oof, hate when that happens. I thought this was kind of cool. Feel like Gucci says, being early is the same thing as being wrong. And then Michael Gayed says, I'd rather be early and wrong than late and wrong. I will say this. Yes, being early can be perceived as being wrong, but being early can also mean that you can load up on whatever asset you are buying longer. And since the short-term market movements, in my opinion, cannot be timed with any degree of certainty or a high enough degree of certainty to make it worth it, being early is essential. And if being early is wrong, then you must be wrong to make a lot of money. That is my opinion. So you cannot time things when you're 3 weeks right before it and be like, oh, I'm just going to stroll in here and make a 10-bagger. I know it's going up a 10-bagger. You might be early. You might be 6 months to a year early or more if you're playing the long-term game. So this quote, in my opinion, it is factually correct, perhaps, but I also think it's financially stupid because you won't make the big money on a long-term time frame if your time frames are long. I thought this was pretty good. I like this Logan guy. I'm starting to warm up to him. He says, do you guys think people who are getting married, having sex, and having kids care about what happens to the boomers 8 years from now? That's a great statement. When I was buying a house, I'll be honest, I wasn't thinking about that. The majority of people don't think about that. 99.9% of the people probably don't think about the boomers passing away 8 or 10 years from now. And this is what all these people, this is what a lot of us out here in the peanut gallery are focusing on. Not as important today, but 5 years out, oh, it's a game changer. So let's go with Logan. I like Logan here. He's on his super high intensity training, which is SHIT. Why are the old cranky men on Twitter, who I know aren't having sex, think they can sit on Twitter saying the boomers' deaths are coming, which is their own death, by the way, saying, we are Japan, will change the mind of young Americans having families. Now, here's the population declines in both Europe, Japan in the coming decades. Europe declines, Japan is declining and will decline, and the United States not declining. It is going higher. Our population is increasing even out to 2100. So maybe these guys are wrong. He says, what did the Fed do to your sex life that has made you the grumpiest boomer ever? Because you're not getting good yield on your savings account? Can you imagine telling your 29-year-old wife, honey, we can't buy a home until 2035 because the boomers are going to die and they will flood America with tons of homes? Really? Let's see how that works out because it's going to work out better for the next guy. I just thought that was funny, guys. Coming on down. Yeah, another one about Global demand rose by 3 million barrels in March, highest level ever recorded. We've got Shabam here. So I'm painting a picture is what I'm doing. I'm painting a picture of the demand, and let's paint the picture of supply. It says, although longer laterals improve per well economics, they result in higher decline rates and lower recoveries per section. Permian is now at its inflection point with production flat to down over the last 7 months on its way to a year-over-year decline come fall of 2023. Invest accordingly. So here's the Permian oil production. We've got 2019, 2020, 2021. I'm just trying to see what he says. 2022 is the black, and then 2023. And he's got it coming as a decline here, and he thinks that this is going to continue to decline going forward. So that's what we've got for now for Permian oil production. He's got Lee and Eddy County responsible for 50% of Permian's production increase over the last 2 years, looks to be suffering from an almost comedic well productivity degradation. Longer and longer laterals and overcapitalization meet the laws of physics and reservoir fluid dynamics. So here's 2018, 2019, 2020, and here we go. 2021's falling off. 2022 is not doing very well, and 2023 is going to be even worse. Good luck with your cumulative oil production from these wells. They're drilling less, they're drilling more and getting less. Coming on down, it says U.S. existing home sales fell 23% over the last year, the 20th consecutive year-over-year decline. That's the longest down streak since 2007, 2009. I will say, yes, sales have fallen. Prices have been resilient. So we need to look at the data deeper than just sales. I didn't grab anything. I just wanted to share and make my opinions well known about this. Is that yes, sales are slowing. Some people will say, well, sales is the volume. It's the leading indicator of what price will do next. We'll see. We'll see. If that demographic and the market is short as many homes as we think it's short, then we won't see prices fall. We'll see inventories remain low, and we won't see that those prices fall to the downside. Now, here's something I want to talk about. A daily 1% improvement doesn't sound like much, but it compounds to 3,678% improvement after 1 year. Take the challenge. Improve one thing in your life, 1% each day. It's life-changing, says Blake. Now, here is my opinion. Let's yank up. So what he is saying, he's saying that life moves like this. 1% a day, and you get to exponentially move higher. I don't think so, buddy. Life does this. In the beginning of whatever you're doing, this can be return here, and this can be your time frame, your time. It's easy to make big gains in the beginning, but then it gets harder and harder as time progresses. And eventually, you'll get a point where you hit a point of basically you don't want to progress any further past that. So that is the point that you want to stop, whether it's here or here or here, wherever it is. But you don't want to be dumping in more effort for this little gain in here. So what I would say here is it doesn't do this. He is wrong. When you go and you work out, you get your largest gains in the beginning. If you have never worked out to working out, it all happens in the first year. After that, it becomes exponentially more difficult as you become more, as you become stronger and your body becomes less surprised by your workouts. Put it that way. That happens with everything in life. You can't make a bathroom 1% cleaner each day and get 3,678% improvement. You'll get a large improvement when you first clean it and redo it in the beginning, and then it becomes exponentially harder and less valuable the more effort you put into it. Just like everything in life. So I don't really like this quote. Just wanted to say that. I'll skip through the egg thing. This is interesting. It says, let's talk about inflation and what it may mean for the markets going forward. This is U.S. term premium. I'm not really going to dive into this one too much, but let's go through some of his things going down here. It says, the early to mid 1970s was a period driven by rising inflation, and the inflation outlook remains a critical part of the equation for the current cycle. If we are indeed in a renewed period of structurally high inflation, then it is easy to argue that the current secular bull market is in its twilight. After all, declining interest rates and low inflation and financial engineering were an unmistakable part of the landscape after the great financial crisis. The 10-year term premium was 3.5% in 2008. It fell to minus 1.21% in 2020, and it still remains negative at minus 0.67% now. A negative term premium is hard to square against a backdrop of structural inflation and a shortage of bond buyers. That's the end. So buyers and sellers of U.S. Treasuries, we've got a year-over-year change in Treasuries held by the Fed's SOMA. It is declining. So a negative term premium is hard to square against a backdrop of structural inflation and a shortage of bond buyers. So this is going to get really interesting in the bond market. Coming on down. So this is Elf's opinion. It says the best macro investors are right only 55% of the time. That's why they are always asking themselves, what if I'm wrong on my thesis? Making money when your thesis is playing out is easy. Not blowing up when you are wrong, that's the key, at least to his opinion. If you have a thesis that is very long-term, like a structural bull market in commodities, given high inflation, then you're going to have periods of time where it looks like you're wrong because you're playing a structural move that spans over cyclical pullbacks. So yeah, not blowing up is great. That is the key, but it also doesn't invalidate the overall thesis on a longer term time frame, which makes it very difficult to know when you're right and when you're wrong. That's why technical analysis plays a big role on figuring out where you are in your thesis and having an unbiased opinion showing you data that backs or refutes your thesis. Narratives and opinions do not refute your thesis. Some data may not even refute the thesis. And price movements may go against your thesis in the short term and will not discredit your thesis. So what exactly is going to ensure that your thesis is correct? That's some of the hardest parts to ensure that you're continuing to move forward. If the thesis is right, it should be in alignment of a lot of data supporting that thesis. It's basically taking, it basically means your thesis is measurable to some degree, and you can measure certain indicators to ensure that the thesis is still correct. I think a lot of people's theses are not long enough or structural enough to make it worthwhile to even follow. You can have a thesis and it may work or not work, but you have to make sure that whatever you have put in place and whatever you're trying to prove or guide yourself, or the paradigm that you've got for that market, it needs to actually have leading indicators and be measurable. If you have nothing to measure it with or against, then you don't know where you're at. And I think we do a very good job on the channel here on measuring all this stuff and being able to measure it. Here's another one. Justin says, with interest rates rising since 2021, the share of the government's budget that is taken up by debt service has risen as well. There is a limit to how far rates can rise when debt levels are excessive. And perhaps we are nearing that point now in the Fed cycle. I agree exactly with that. So these are real rates, debt, and demographics. You can see the 10-year real yield core. We're still down in a negative for the 10-year real yield core. It's minus 0.9%. Or 0.9. TIPS 10-year real yield 1.2. The R estimate is 0.84, and how these things correlate with each other. NARF. Okay, so we've got things are so terrible that world oil demand hit an all-time high in March. I love it, guys. Stick it to them, Eric. I love all these guys. The recession bros, and we're hitting all-time highs with oil. Now I want to see what the second stage is when the effects of the cutback of Saudi Arabia, or OPEC, I should say, not Saudi Arabia, but OPEC, the cutbacks of OPEC and higher demand, what this is going to do to inventory levels. It's going to soak these inventories up so quickly. Druckenmiller bullish on copper. Copper is in the tightest position compared with any environment I've ever studied. Afraid to be long copper during a hard landing. Coming out of a hard landing scenario, copper will be a huge beneficiary of the electric vehicle boom. Love to see it. He's probably wanting, all these people are hoping for a hard landing so everything crashes. And then they can load up on copper and all these different commodities. That's what they're hoping for, at least. Here's home builder confidence is about to enter expansion mode as new home sales have been growing recently. And we just saw home sales decline, but it's been growing here in the very short term. Few understand. I hate that. We need to start getting rid of that crap. Output from Codelco, the world's biggest copper supplier, is running at its lowest level in a quarter century. Look how low that is, guys. Guys, we are going to hit a huge problem in this stuff. Come on. It says not too much for the majority of 30-year fixed loan households. This is the majority of 30-year fixed loan households. This is their mortgage debt service payment as a percent of disposable personal income. Very low for those who got in before 2020 and refinanced. We refinanced all the way down here, guys. That's what happened. We refinanced very low. This is noteworthy. So Tavi says, consumer discretionary companies just reported 40% contraction in earnings relative to the same quarter a year ago. These businesses are currently facing significant margin pressures and are yet to experience the full impact of consumer weakness. So let's just look at the chart here. We can go, I don't need to read all through this. The S&P 500 sector's earnings growth, consumer discretionary, financials, those are all down. That's what we should see in a commodity bull market, in a 1970s type of environment. Real estate's barely down. That's generally higher. Utilities up, materials up, industrials up, and energy way up. This is what I think it's going to look like for the next decade. And if we have shortages in energy, guys, on a worldwide basis, it's going to make the 70s look like freaking peanuts. We are going to try to ramp energy at an incredible pace, guys. I don't know how to explain all this. I think the way that I do it is I'm going to go over into energy and just go sit there. I'm going to go into physical metals and sit there. I'm going to go into these things because the way that I see it is that the environment is very similar to the 1970s. The 1970s was America only. That was it. America only. And it caused a gigantic boom in America. This is worldwide. There is no place that we just go grab another pool of oil somewhere else in the world. If it's worldwide, we got to go to another planet. And anyone who's in engineering and who's in aerospace and all these guys, very hard to move weight. I don't think we're going to be moving copper from other planets. First of all, it takes you 1.5 years to get to Mars, 1.5 years on Mars, and 1.5 years to get back for the right location. So it takes 4.5 years to basically go to Mars and come back. So that's not going to happen with current technology. We are a long ways away from grabbing materials from another planet. A long ways away. I think that the shortages of copper are going to drive lower and lower ore grades into production, which is going to be shortages of energy. So energy is the least, it's the most how can I say this? It's the easiest way to play the most amount of shortages in metals, because a shortage in copper, yeah, you can play it directly with the physical metal, but it's going to be hard to play it with miners because the miners make their money off the margin of yanking stuff out of the ground. A mining company is a derivative of energy. So the question that you might want to ask yourself is, I think the big opportunity here for investment is, how are they going to get cheaper energy to mines? And I'm sure some of you guys, small modular reactors, something like that, that very well could be the case, and that could be where all the money's made. Small modular reactors on sites to produce electricity in ever increasing energy amounts. And we need stuff that produces a lot of energy. Now, that could be the first thing, but I just still don't think they're going to yank this stuff out of the ground at faster and faster flow rates. So I think that the physical metals themselves will probably be a very good bet, because your cost curves are going to go up. You're going to need, I think it's going to take a long time to yank this stuff out of the ground in terms of flow rates. So the flows will go down, and it's going to require a lot more energy and a lot more inputs that are more costly. And then we're going to have to find solutions to get cheaper energy out there. So that's what I've got there, at least in my opinion. I think energy is probably the best area to be looking at for the remainder of human life. Energy is where it's at. Energy is wealth. Energy is what backs currencies. If you have a long enough problem with energy, your currency could have problems too, because energy is the basis of GDP growth. Energy backs bonds, energy backs currencies, which is all debt. So you can say energy backs debt. Energy is the reason that debt can exist and fiat currencies can exist, because that's the GDP that grows alongside the debt. So energy, I think, is the most vital role that you can invest in, which is also at the same time not a unique investment. It's something that's used on a basis where everyone uses it for their input. So all manufacturing facilities, whether you're and all banks and all whatever, uses energy as an input. So it's the most universal, basic thing that all companies use, which is energy. So energy is the most universal, the most universal investment that I think will be in short supply at some point, where we may or may not have good solutions for. Whatever that next solution is, will probably be the largest returning investment that we'll see in any time frame. And that's where I get highly bullish on it. And it could be uranium, it could be nuclear powered small modular reactors or something like that. It could be something like that. It very well could, and I think a lot of people are betting on that. But that's what I've got for today. Thumb up for the content, subscribe to the channel, subscribe to the website if you guys are interested, and we'll catch you next time. This is Finding Value.